Everybody, in this video I will show you a sample exam question related to capital investment or capital budgeting, particularly related to advanced technology. This is a past year exam question. I have many videos related to management accounting. Feel free to subscribe my YouTube channel so that you can see past videos and also future videos related to management accounting, related to how to do management accounting. Okay, in this question, you can see the question here. Delima Sindrian Berhad is considering to purchase a 500,000 machine to manufacture security parts for home alarm system. Delima expects to sell all it can manufacture in the next 10 years. The machine is expected to have a 10 years useful life with no salvage value. Delima uses straight line depreciation method and a 13% discount rate in evaluating capital investment. The parts are expected to generate annual net cash flow. Net cash flows means cash in minus cash out of 100,000 ringgit each year for 10 years. Okay, this is a straightforward question. So let's see. The first question, compute the payback period for the project. This is very easy. If you want to answer this question, you have to remember the formula to calculate the payback period. This formula can be used if the net cash flow is same every year. Like this question, the net cash flow is $100,000 every year for 10 years. So you can use this formula. So to answer this question, so you have to show the initial investment of $500,000 divided by the net cash flow for every year, $100,000. So you will get that the cash payback period for this project or for this machine is 5 years. So it takes 5 years for the company to get back the amount that the company has invested. Remember, the shorter the payback period, the better the investment. Okay, second question. Determine the accounting rate of return for the project based on the initial capital investment. So you can see the answer that I have written in red there. So to answer this question, the accounting rate of return, you have to remember the formula. The formula, you can see that the formula is average annual income divided by the average investment. Okay, for this question, see, how much is the average annual income? Income, another word for income is profit. So how much is the profit for this machine annually, every year? So every year, the profit is like this. See the next to the formula there? To calculate the profit, the basic calculation is revenue minus expenses. In this question, you can assume that the revenue of that can be generated from the machine is $100,000 per year. That is equal to the net cash flow, 100,000 per year. So that is the revenue. So minus expenses. So what is the expense? related to this machine that you can see from the question. The only expense that you can see is the depreciation expense. So the depreciation is calculated using straight line method, and the useful life of the machine is 10 years. So see here, $100,000 revenue minus the depreciation for this machine is $500,000, the value of the machine, divided by 10 years. That is the straight line method. So that is the income. Divided the average investment. So you have to memorize this. To calculate the average investment, the formula is the amount of the investment, 500,000, plus salvage value. In this question, there is no salvage value. So the salvage value is 0, divided by 2. That is the formula. It is always divided by 2. So if you calculate the number, you will get that the accounting rate of return for this machine or project is 20%. Okay, and then question 3 asks you to calculate the internal rate of return for the project. The calculation of internal rate of return is a bit complex. You have to use the scientific calculator, or at least you have to do some estimation and use the table for present value. So I skip this one. Maybe later I will make a video only for the calculation of the internal rate of return for a project or a fixed asset. Okay, we go to question number A4. Question number A4 asks you to compute the net present value of the project. So calculation of the net present value is like the one that I have written in red here. See here, net present value or NPV equal to investment minus present value of the net cash flow. So see here, the investment in this question, the investment is $500,000, and then the present value of net cash flow is $100,000. That is the net cash flow times 5.46. Okay, 5.46 is the present a number that you can get from the present value annuity table. There are two types of present value table. One is for present value. Another one is a table for present value annuity. You can use the present value annuity table if the amount of cash every year is same. Like in this question, every year the company is expected to get $100,000 every year for 10 years. So then the cash flow, the net cash flow is same every year. So you have to refer to present value annuity table. If the cash flow every year is different, then you have to refer to another table, which is the present value table. Okay, so for this question, $500,000 minus $100,000 times 5.46 equal to negative 42,600. So you can see here, when the net present value is a negative number, it shows that the investment is most of the time is not a good investment, because the present value of the cash flow is is supposed to be 500. Is negative. So it is less than the initial investment. Oh, I have to write this again. So let's see. The initial investment is $500,000 minus the present value of the cash flow is negative. So it's supposed to be the number here is negative 4,600. Supposed to be positive. This is something wrong here. So the present value of net cash flow is higher compared to the initial investment. The present value cash flow is like 546,000 something, and then the initial investment is 500,000. So the net cash flow is higher compared to the initial investment. So this is supposed to be showing a good investment. The net cash, the present value of cash flow that the company can get from the asset is like 546,000. It is higher compared to the initial investment of 500,000. So this is supposed to be a good investment. Okay, so for question number 5, would you recommend the project? Why? So I think the answer is supposed to be yes. The answer is supposed to be yes, because you can see here the investment is a good investment, because from the number 1 you can see the payback period is 5 years, so we cannot say yes or no for that because we don't have something else to compare. But when we see the second method shows that the rate of return is good, 20%. And then we can see that the net present value is also good. The present value of the net cash flow, total present value of the net cash flow is higher compared to the initial investment. So the answer for number 5 is good, because the net present value is positive, supposed to be positive. And then the accounting rate of return shows the 20% return. So it is a good investment. So I'm not correct in my writing here, but the answer is a good investment. Okay, B. Accounting profit is suffering from deficiency of GAAP. Okay, GAAP is generally accepted accounting principle, or the term that we always use is accounting standard. So this question asks you, the statement is like this: accounting profit is suffering from the deficiency of accounting standard. The question asks you to use 3 points to discuss this statement. So how to answer this question? So the answer that you can give is like this: deficiency or weaknesses of accounting standard, or GAAP, that make accounting profit can be manipulated. There are 3 deficiencies or weaknesses. The presence of these 3 weaknesses or deficiency makes the accounting profit can be manipulated. Why this question? Why this question is asked related to capital investment? This question is asked because if you use accounting rate of return method to do capital budgeting, then you have to use accounting profit. See the formula there? Average annual income or average annual profit. So that profit can be manipulated. Why it can be manipulated? Because there are weaknesses in the accounting standard or GAAP. These weaknesses is something that almost cannot be avoided, because the standard setters, they want to make the accounting standard to be flexible. So when they try to make the accounting standard flexible, they have to allow several estimation method, several they have to allow capitalization of expense and inventory valuation. They have to allow that. When they allow that, the bad side of that flexibility is the accounting profit number can be manipulated by using this flexibility. Okay, so I have to I will read again the question and the answer. So the question says, accounting profit is suffering from the deficiency of accounting standard. So using 3 points to discuss 3 points, discuss this statement. So the thing that you can do to answer this question is like this: deficiencies or weaknesses of accounting standard that make accounting profit can be manipulated are 3. First, estimation method. So the GAAP or accounting standard allows companies or businesses to use several estimation methods. For example, when a company want to calculate depreciation expense, the company are allowed to use several methods like straight line method, reducing balance method. I think another one is called output or quantity of production method or something. So the depreciation is calculated based on the quantity of production or unit of output or something. So for a company, they can choose the method that will show the highest profit. That's the thing that they can do. The second point is the capitalization of expense. The accounting standard in some situations allows companies to capitalize their expense. So when a company decide to capitalize its expense, the profit will increase, because when a company capitalize its expense, the expense will become lower than if the company record the item as an expense. And number 3, inventory valuation. You have learned in financial accounting, if you have a business, you can choose to use several methods to calculate the value of your ending inventory. I think the methods that I can remember is FIFO, LIFO, and weighted average method. So when you choose one method or one inventory valuation method, that method can affect the amount of profit of a business or company. So that these 3 factors or points makes the GAAP, and these 3 points are the weakness of GAAP, and these weaknesses or deficiencies allows a business or companies to manipulate the profit number, and this makes the capital budgeting analysis also will be affected by these 3 points or factors. Okay, the last one is advanced technology investment is difficult to be measured based on capital budgeting. Discuss the 3 non-financial benefits of this investment. So, if you can remember, when we discuss about this topic 6, which is about the investment in advanced technology, one of the things that you have learned is investment in advanced technology has several characteristics that are different compared to the traditional investment or investment in traditional asset like building, motor vehicle, equipment, etc. One of the things that is unique to investment in advanced technology is most of the time when you invest in advanced technology, the benefit that you can get from the investment is cannot be expressed in terms of dollar and cents. So let's say you invest in advanced technology $100,000 today in your company, and then when you do the calculation using payback period or accounting rate of return or net present value, you will see that the investment is not a good investment because the amount of the investment is expensive. Advanced technology is expensive, but the return is the return in terms of dollar and cents is very low. Most of the time, investment in advanced technology generate returns in the form that cannot be expressed in terms of dollar and cents. So see here, discuss 3 non-financial benefit of the investment in advanced technology. So the most of the time, the benefits of investment in advanced technology are in the form of non-financial benefits, including the 4 points that I have written here. The first one is reduce space. So the easier example is like I think when you invest in advanced technology, most of the time let's say the equipment. If the equipment is an advanced technology equipment, then the equipment must be small. So smaller compared to equipment that uses not advanced technology. So when the equipment is small, so the benefit is maybe not in terms of dollar and cents, but the benefit is reduced in space. Before this, you process your product using a big equipment. Now, if you invest in advanced technology equipment, the machine is small but can do the same work. Okay, the second point is maybe the investment in advanced technology is related to improved productivity. When you use advanced technology, you can produce more compared to before, compared to when you use traditional equipment, for example. So the next point is if you invest in advanced technology, one of the benefit that you can get is improve the quality. Most of the time, advanced technology, particularly advanced machine or advanced computer, they can produce better product, high quality product. Okay, so the next point also that can be said as a non-financial benefit of investing in advanced technology is improve speed. Before you use the advanced technology, machine or equipment, the speed of production is slow. But after you use the advanced technology or equipment, you can produce more quickly compared to before. So this is the past year exam question. I think this question is very straightforward. But the good thing about this question is you can learn almost every method in the covered in the topic 6, investment in advanced technology. See, first here you have learned about you can see how to apply or to use the payback period method, and then you can see how to calculate the accounting rate of return or to use accounting rate of return method to analyze an investment. And then I skip the internal rate of return method because of the complexity of the calculation. Maybe I will share with you another video, or I will make another video only for this method. And also you can see the net present value method. This is a simple one because the present value is the annuity present value. If you check the lecture notes, I think I have shared a sample question about how to calculate NPV if the net cash flow every year is not same. So this is the simple version, is simple one. And then number 5, you can see that the question asks you whether the investment is a good investment or not. Okay, so the basic way to make decision whether the investment is good or not is you check the calculation that you have done. So there are 4 methods, but we do only 3 methods. So clearly, 2 from 3 methods shows that the investment is good. The accounting rate of return method shows the investment is good, 20% return. The net present value also shows that the investment is good because the net present value of the cash flow is higher compared to the initial investment. That is good. So we can say that this investment is a good investment, or this project is a good project. The one that I have written here is not correct. It's supposed to be yes, it is a good investment because the payback, the accounting rate of return method shows 20% return, and the net present value method shows the investment will generate positive net cash flow or present value net cash flow. Okay, so and then question B and C. See, question B is like testing your knowledge about the effect of calculation of profit on the calculation of the capital investment analysis. So here you can see from my explanation, I hope you can understand that the calculation of profit can be manipulated because of these 3 factors. When the calculation of profit can be manipulated, it means that the calculation of the at least one of the capital analysis method or capital investment method also can be manipulated. So here the accounting rate of return method, you can see that it is based on income or net profit. So this number can be manipulated. So the results of this calculation also can be manipulated. So the question C asks you specifically about investment in advanced technology. So you have to understand about that. In topic 6, we have discussed, we have done a long discussion, have provide a long explanation about the nature of investment in advanced technology. The investment in advanced technology is very important to ensure the survival of a business. But the problem is, it has most of the time the benefits from using or investing in advanced technologies cannot be calculated in terms of dollar and cents. For example, here I have explained at least 4 factors and non-financial benefits of investing in advanced technology. Thank you very much. This is the end of this lecture. This is a replacement lecture for last week, Thursday. Thank you very much. Do not forget to write your name and metric number in the comment section.